There is a specific candlestick pattern designed to signal the exact moment a trend reverses. It is called the kicker pattern. In this tutorial, we will break down how to identify this pattern on a live chart, how to filter out weak signals using volume, and how to automate your search using a digital scanner. This strategy is built for swing trading, so you will need to set your charting platform to the daily time frame to follow these steps correctly. Recognizing the kicker pattern provides a clear framework for identifying entry points before a new trend gains momentum. A bullish kicker is a buy signal that appears when market sentiment shifts abruptly. It requires 3 specific conditions to be met in order. First, the market must be in an established downtrend. Second, the final candle of that trend must be a bearish red candle. The third condition occurs the next day, when the price opens above the previous day's high, creating a gap up and forming a bullish green candle. This gap is the defining feature of the pattern. The rectangular bodies of the 2 candles cannot touch. While it is acceptable for thin wicks to enter the space, the solid bodies must remain completely separated. When these rules are met, the setup indicates that buyers have taken control, and the price frequently continues to climb in the following sessions. Note that if you see this gap up occur in the middle of an existing uptrend, it is not a kicker. To be valid, it must appear at the end of a downtrend. The bullish kicker represents a sudden shift in market psychology, where the previous selling pressure is immediately overtaken by new buying interest. The bearish kicker is the exact opposite setup, used to identify when an upward trend is about to collapse. This setup starts with a clear uptrend, ending with a bullish green candle. The next day, the price gaps down and forms a red candle. Again, there must be no overlap between the solid bodies of these 2 candles. This specific visual signal often precedes a sharp price decline. Always check the context. A gap down is only categorized as a bearish kicker if it interrupts an established uptrend. This specific pattern shows that buyer confidence has completely evaporated, leaving the market vulnerable to a rapid reversal. To increase the reliability of your trades, you can use 3 specific confirmations to filter out weak setups. First, the larger the gap between the candle bodies, the stronger the signal. Second, look for candles with very short wicks, like setup B. This suggests that the momentum is decisive and uncontested. The third confirmation is volume, which represents the total number of shares traded during the formation of the pattern. When a bearish kicker forms, you want to see an unusually tall volume bar on the red candle. This high activity proves that sellers are actively exiting their positions or entering new shorts. Using these 3 filters, gap size, wick length, and volume, allows you to focus on the strongest setups while ignoring low-quality market noise. Searching for this configuration manually across thousands of individual stock charts is inefficient. Use a screener like Charting to automate this. Selecting the kicker filter from the drop-down menu lets the software scan the entire market for you. This scan provides an updated daily list of stocks that have just met the criteria for the kicker pattern. For instance, if the scanner identifies a stock like LTI Mindtree, you can immediately open that specific chart to verify the gap and volume confirmations. Automating the discovery phase saves time and ensures that you only spend your energy analyzing valid setups. You now have a complete system, identification roles, the 3 pro confirmations, and a method for daily automation. If you are ready to begin trading these setups, links to open DMAT accounts with Zerota, Upstocks, or Angel One are in the description below. To learn about other essential patterns, visit our Candlestick playlist and let us know in the comments if you found this breakdown helpful. Mastering one pattern through a systematic approach is more effective than relying on intuition. Trade carefully, and we'll see you in the next tutorial.